The clang of the cash register, an anxiety-inducing reminder of rising costs.
Yeah, it's just a hell of a mess right now.
The cost of living making it harder to get by and leaving little hope for the future.
We talk about possibly leaving Canada because why should we stay here? Just be overtaxed, underserviced, healthcare sucks, education sucks, government is bloated.
A new RBC poll found 59% of British Columbians feel financially paralyzed due to rising costs, 4% higher than the national average.
Canada's economy is at a critical turning point. Interest rates, inflation, job markets, everything is shifting. And whether you're a homeowner, an investor, or just someone trying to make ends meet, the decisions made by the Bank of Canada in the coming months will directly impact your financial future. But what exactly is happening? Why are interest rates fluctuating? And what does this mean for your mortgage, savings, and overall cost of living? In today's video, we break down the latest Bank of Canada decisions, what's driving them, and what they mean for you. Stay with me until the end, because understanding these changes could help you make smarter financial moves. Let's dive in. Where does Canada's economy stand right now? Before we analyze the Bank of Canada's latest moves, let's first understand the current state of the economy. 1. Inflation pressures. Canada has been battling high inflation for the past few years. While inflation has cooled down from its peak, it still remains a major concern. Prices for essentials like food, housing, and energy continue to rise, making it harder for many Canadians to maintain their standard of living. 2. Interest rate hikes. In response to inflation, the Bank of Canada aggressively raised interest rates throughout 2023 and 2024. These hikes were meant to slow down spending and borrowing, but they also made mortgages, loans, and credit card debt more expensive. 3. Job market and growth. Canada's job market remains strong, but signs of a slowdown are emerging. Businesses are hiring cautiously, and wage growth is struggling to keep pace with rising costs. 4. Housing market. The housing sector is facing uncertainty. High borrowing costs have cooled down demand in some areas, while in others, a lack of supply is still driving prices up. Many homeowners with variable rate mortgages are feeling the financial strain. So, where does all of this leave us? At a crossroads, and the Bank of Canada is making critical decisions that could either stabilize the economy or trigger further challenges. The latest Bank of Canada decisions. The Bank of Canada's recent decisions have been closely watched by economists, businesses, and everyday Canadians. Let's break down the key actions. 1. Interest rate adjustments. The bank has signaled a possible pause or reduction in interest rates after a series of aggressive hikes. If rates stay high, borrowing remains expensive, but inflation may slow down further. If rates are cut, it could stimulate spending and investment, but also risk reigniting inflation. 2. Inflation control measures. The bank is using monetary policy tools to keep inflation in check. This includes managing the supply of money and encouraging banks to maintain stricter lending standards. 3. Economic growth strategies. The central bank is balancing economic growth and stability. If growth slows too much, it risks triggering a recession. If it grows too fast, inflation could spike again. 4. Housing market policies. Policymakers are discussing new measures to stabilize the housing market, such as revisiting mortgage stress tests and adjusting lending requirements. Each of these decisions has direct consequences for Canadians, whether you're looking to buy a home, invest, or simply manage your expenses. What these changes mean for you now. Let's talk about how these bank decisions will impact your daily life and financial plans. 1. If you have a mortgage or are planning to buy a home, Fixed-rate mortgages are becoming more attractive as interest rates stabilize. If you're locked into a high variable rate, refinancing might become an option in the coming months. For first-time buyers, a potential rate cut could improve affordability, but housing prices may also rise as demand returns. 2. If you have loans or credit card debt, higher interest rates make it more expensive to carry debt. Paying down high-interest debt should remain a priority. If rates drop, borrowing may become easier, but staying financially disciplined is key. 3. If you're a business owner or investor, lower rates could mean easier access to loans and investment capital, but uncertainty remains. Investors should watch economic indicators closely. Sectors like real estate and tech could see renewed growth if borrowing costs decrease. 4. If you're saving for the future, higher interest rates have been good for savings accounts and GICs, but if rates drop, returns on these may decline. Consider diversifying investments to balance growth and security. Understanding these impacts now can help you make better financial choices in the months ahead. What's next for Canada's economy? The next few months will be critical in shaping Canada's economic direction. Here's what to watch. 1. The Bank of Canada's next meetings. Future rate announcements will indicate whether policy shifts are coming. Economists will analyze inflation data and employment trends for signals. The Bank of Canada's decisions over the next few months will be critical in shaping the country's economic future. With inflation still a concern and interest rates at a potential turning point, the central bank must strike a delicate balance, keeping borrowing affordable while preventing inflation from surging again. For many Canadians, this uncertainty means adapting their financial strategies. Whether it's choosing between a fixed or variable mortgage, deciding when to invest, or simply managing daily expenses, the next phase of Canada's economic cycle will demand careful financial planning. One major factor influencing Canada's future is global economic shifts. The U.S. Federal Reserve's actions, ongoing geopolitical tensions, and supply chain challenges will all have ripple effects on Canada's economy. If global inflation continues to ease, it may allow for softer monetary policies, leading to lower interest rates and improved economic stability. On the other hand, if energy prices or trade disruptions spike again, Canada may face another wave of economic pressure, forcing the central bank to stay cautious. This means businesses and consumers alike need to remain flexible and prepare for multiple financial scenarios. At this point, the best move for individuals and businesses is to stay informed and proactive. Whether it's adjusting investment strategies, exploring debt repayment options, or keeping an eye on policy changes, financial awareness will be key to making smart decisions in this uncertain climate. The coming months could bring new opportunities for growth or renewed economic challenges. But one thing is clear: those who stay ahead of the trends will be in the best position to navigate whatever comes next. So, as Canada stands at this economic crossroads, the real question is, are you ready for what's ahead? For those navigating these uncertain times, staying informed is your biggest advantage. Now is the time to review your finances, plan for different scenarios, and make smart decisions based on real data. Whether you're refinancing a mortgage, managing investments, or just trying to make sense of it all, having a clear understanding of these economic shifts will put you ahead. So, what do you think? Will Canada's economy stabilize, or are we heading for more turbulence? Share your thoughts in the comments. And if this breakdown helped you, don't forget to like, subscribe, and stay tuned for more financial insights. Until next time, stay informed, stay prepared, and take control of your financial future.